You said that there was a hat trick that took place over the last 3 months that has made you much more optimistic about these stocks over the next 3 years. What was the hat trick, and what's it mean?
Yeah, well, as you know, a hat trick is when you score 3 goals in hockey or soccer.
I know what a hat trick is. I know that part.
But there's been 3 positive events. Each one in their own right would be a game changer. But to get all 3 at the same time is like a 1 out of 500 occurrence. The first was Pfizer Monday, November 9th, with the vaccine development, and you saw the J&J news. That's more positive, and that helps to reduce the credit losses at banks. The second would be Fed Friday, or December 18th, and that's when banks were permitted to resume share buybacks, which start after they report earnings. And the third would be Georgia Tuesday, or last week, when the Democrats retook government, which means more spending, the reflation trade's back on, a steepening yield curve, and that helps to reduce the pressure on banks' net interest margins. So it all adds up to our theme for the year, which is on the road again. Banks are on the road again to the pre-pandemic returns and valuations that they had a couple years ago.
Are you changing your ratings, your price targets for any of these banks based on that, or you think there's potential for upside?
Well, back in March and April, we upgraded 2 of the 6 largest banks, and so we recently increased our 3-year price targets on Citi, Bank of America, and JP Morgan. Bank of America is our favorite for the year, but our 3-year price targets, we have 50% upside on average for those 3 over the next 3 years in a low rate environment. But if we get to a more normal rate environment, we actually see Bank of America, Citi, and JP Morgan doubling. So we still see a lot of upside. And Becky, the pushback is, oh, wow, the bank stocks have performed well. Well, they've only recaptured half of the underperformance since Pfizer Monday, since November 9th. They've still underperformed the market as a whole by 19 percentage points versus the past year. So we still see upside.
Mike, you're always pretty colorful, and I liked one of the things you put in the note. You said people want to date the bank stocks, but they really need to be in a more serious relationship. I guess they need to marry up. Why is that?
Well, you don't have to get married, but it just doesn't have to be a one-date situation either. I mean, before the pandemic, banks were doing just fine. They were on the road toward record efficiency with annuity-like earnings and buying back stock. They were bond proxies. And we think once banks show that they're resilient enough to come through this recession, not only without issuing equity, by the way, they're buying back stock, but with better market share for the largest banks, then they could be valued more like bond proxies. That's a blue sky scenario that's not in our numbers, but there is a lot of underappreciated improvement at the banks that wasn't fully appreciated before the pandemic. And after the pandemic, I think you get the combination of resiliency, annuity-like earnings, better efficiency, and the pandemic has really changed customer behavior in a matter of months, but would have taken years, and that allows banks to become more efficient by more digital banking. So there's all sorts of, there's a peace dividend in Act 1, and then Act 2, you have this efficiency story. And that's, once again, we're saying we're on the road again toward that record efficiency where banks were headed pre-pandemic.
Shepard Smith here. Thanks for watching CNBC on YouTube.